Good morning, guys. What's up? This is Victor, your man from Digital Age FX, guys. I'm here trying to analyze gold. We just want to go through what's been happening with gold from this point up to where we are currently. So I'm gonna take you through that, guys, and stay tuned. Learn. Thank you. Let's go. Let's do this. So yeah, with what we have here, we've got gold. Okay, good, good. But guys, the first thing first is you need to, when you look at the market, you have to understand the overall direction. In this case, we've got the overall bullish direction, overall bullish market, and we should anticipate for price to actually go more bullish. But I'm going to take you through in terms of how do you get to that point without guesswork. And this is how you do it, guys. After you understand the overall direction, if we go to the biggest time frame, we've seen that gold has been going to the all-time high, so price has been bullish. So I've just taken the current price and to work with that. So let's do this, guys. I don't know what happened to my time frame, but I hope we're not going to change the time frame. We're going to stick to this current time frame that we have. So first thing first is we have to identify our highs and lows. And here we've got the lowest point after breaking of that structure was that point. And price, it seems like price was making a correction. So what you do is you'll go to the second lowest point, lower high, before the lowest low. So we take that as our liquidity level. Of course, we have to highlight that as well. Let me just mark it out, because this was the liquidity point for when price was pushing up to this distance. So we could have literally used that to accumulate to get this move. Okay, and then we've got this move here, right here. We've got a move here. This move basically gives us, this is a liquidity point. Liquidity point, and we've got another liquidity point, liquidity low. Basically here, the type of liquidity you get here is what we call sell side liquidity. And this means that the retail traders taking buys from these lows, they're actually leaving stop losses, and where stop loss exists, there will be found liquidity. So you always get liquidity below points where price above and highs where people have left stop losses. Because of the stop losses, there we have liquidity. And you can see that the big markets, the banks and the institutional traders, they will normally buy and sell. They'll buy and sell here. Why? Because they're literally using the sell orders to take out the stop losses, but they are mainly buying. Their goal is to mainly buy this market. Their goal is to mainly buy this market, but they'll use the sales orders to take out the people in the market. And after they have taken people out of the market, that's when the banks and the institutions bump more or open more open or press more positions. That's why a market will usually give a good impulse after sweeping liquidity. Now remember always this move, we don't want to trade this move. We're looking forward to trade the correction, the end of the correction of this move. That's what we trade. Okay. So I hope guys you get that. And okay, so we have identified the lows. Basically, we also need to identify the highs. So the lows are your demands, the highs are your supply zones. So this is our supply zone. I mean, when I mean supply, this is where people are selling off of, and we have to mark the demand zone as well. We have to mark the demand zone as well. So guys, yeah, we've got the overall trend, bullish trend, and now we've got the overall support and resistance. I'm gonna add the support and resistance for the upside once we get there, but for now let's focus on that. Now always remember that in the market, your support and resistance is your trends, and your trending trends or your internal trend lines will be very important for how you execute the market. So I think every time price, like you can see, price was moving from there to there. That was a trending trend, and we've got the correction that also is a trending trend. I normally like to put it that much. Okay, let me use, guys, here I'm going to use the normal, let me not some normal, just the individual lines. Yeah, I think something like that. So that was a bullish trend, bearish trend. When price breaks out of this trend in trend, wait for price to correct and start going. But when price starts to close above that previous low level, which is your demand zone, it's when you have to execute the market. It means your stop loss, your entry will be on the close and open of these new candles here. Your stop loss should be below these points that strips liquidity, because in trading you have to become friends with, you have to liquidity is your friend. You have to identify where there is liquidity. Once you spot liquidity, you're in for profit, guys. You're able to make profit easy, because you have understood that the big banks have jumped into the market. They will push the market higher. So that person who's buying off this point is this I call dumb money trader. Dumb money trader. Of course, they make money, but most of the time they get taken out of the market. They get taken out of the market. So these guys, I call them dumb money trader. And yes, guys, so we've got two opportunities, that opportunity and that opportunity. But the most successful person is the person that takes an opportunity after the liquidity sweep. Yes, sir. Okay. So that is a demand zone, that is a supply zone. The same thing, guys, can apply. But if you're in a bullish market, guys, I suppose that we buy as buyers in the bullish market. You ask yourself, in any market, you have to ask yourself, are you going to be a buyer or a seller? Or you ask yourself, who's controlling that market mostly? It's here in the bullish market, it means the buyers are pushing price or are a lot more in that market than the sellers. Of course, with experience, I can use the opportunity here to say price has swept liquidity above that high, and I could literally wait for price to drop below. When it came here, just in the supply zone, I can actually sell this market. But I want to focus, for the purpose of this class, I want to focus on buying from the lows, where you most likely have to, because you're a buyer in this market. Okay, so price sweeps liquidity here. And why I'm saying you can tell that, if you identify that in trend and trends, like so, if you have identified that as a trend and trend, you literally could sell it off that point. Literally could sell it off that point or off that point. And yeah. So how do we trade that then? We wait for price to sweep liquidity, like so, and trade when price closes above. And obviously, when price starts to change character, then you know we bullish. That's a change of character there. That's a change of character. But there was another change of character prior to that, which will lead to price dropping after break of structure. We normally say that after breaking of that structure, price will give us the first lows. So we highlight that first low as our new demand zone. Highlight those two lows, where basically you're buying off that retest of almost price. Usually price would come and break that and retest and then push. and that way you're able to see your opportunities better. But guys, this we can consider that as a retest, and stop loss should be below that low. So depending on the distance, okay, let me just consider, guys, that high again. So depending on the distance, normally price would come back to the supply zone, but depending on the distance between your entry and your stop loss, you have to adjust your lot size, depending on, and also referring to your account size. So that's how we go. That's how we do it. And now we've created a level of liquidity. There is liquidity there. It is also sell side liquidity at this point on those two lows. So we have to be mindful that price usually will come back for that liquidity and then boom to the upside. So we have to explain how we were able to buy from this point to the upside. And this is what was happening, guys. Also, I think, guys, fear of losing in the market plays a major role. In the market, plays a major role in the market, the fear of loss. So price goes and breaks that structure, and after breaking any structure, price will give you the first low in the market. You have then again to highlight that low, of which on those lows there's also liquidity code. Let me try and write this where it's smaller. Let me make this where it's smaller. I hope you can see, guys, if I put it on 10. I just want it to look clean and smart. Okay, so yeah, so we literally are having a good time, guys. I hope so. So we've got two levels, inducement and this lowest low. So price has to take liquidity below all of those lows. So what happens? Let for price gives us that low, bounces, it fails to break the supply zone, which is also our major overall break of structure. But let me take that as our break of structure, a potential break of structure, break of market structure. Okay, so price will have to sweep liquidity below these two lows. Now remember the point, the move, this was the impulse. So what I mean is we have got from that low, from that sweep of liquidity, we've got a new high, not really a new high, almost similar to this previous high spot. From that high, price will make a correction in the form of ABC. Okay, price will make a correction in the form of ABC. Impulse, correction, ABC. Below A is liquidity. So we have to wait for price to take liquidity below that point to actually execute this market. Now that correction on its own needs to have it's a trend in trends. So we've got that low and the point that sweeps liquidity there. So what you need to do is to recognize that trend in trends. Yeah, there. But maybe let me use this way. I need it to be perfect. I'll take these solid lines there. Yeah, there we go. So you can see, guys, I've recognized those trends and trends. This is a good way to wait for price to break above, obviously creating that level there, which is buy side break of market structure. Okay, break of market structure potentially. So price will make it, so from the sweep of liquidity to breaking that previous high there, creating that new high, price will make a correction at 61%. Price will make a correction at 61%. That's where you execute this market, guys. Of course, I want to stress this, that from that high, there's obviously a retest there. So price comes back and retest there, and we buy from there. And the other thing I want to stress is, remember, the banks have bought and sold. For them to establish an entry in this market, you can take the entry there after price closes above and retests. The banks have bought and sold over those areas. So we are buying with the banks to achieve this move. Now, how do you identify how far you can go after buying that level? How do you identify how far you can go? You take that previous high to the entry point. There we go, guys. So that's why price at 423, we obviously had to start anticipating the bearish movement, and that's how we get the target cut. So if Fibonacci are able to tell we are able to identify your targets and your entries and your take profit. So that's how we go, guys. That's how it goes, guys. I just want to change this. Anyway, you can leave them the way they are. But I just want to reduce noise in the market, in the chart. Yeah. But anyway, I'll leave it like that. The other stuff. Then you come here, guys. You can see price has pushed as an impulse. Why I'm saying it's an impulse? An impulse will always have a 1, 2, 3, and 4, and 5. That was your impulse, which is also a trend, an intertrend. So you have to touch these points to there. Yeah. So that was also an intertrend, and that was trend, meaning we are expecting a correction. The correction will usually be 0, A, B, and C. That's where we are. So at this point, we're expecting a price to push towards the upside, but we obviously have to follow what price is doing. So we don't have to we can have an anticipation, but that doesn't mean price will do that. So at this level, at this area here, let me mark out this area, guys. Sorry. So at this level here where there's a supply, you can see we've got that situation. Let me do rather that. Yeah. So price is still here. If price, you can see that price has actually gone above, coming to obviously test, but if it doesn't, then we can see price doing that into that area to downside. But we can still follow price right through. You can follow price the way it's reacting to that level. And yeah, so there we are, the similar correction. We just have to identify the previous low. Price closes above, and we started buying that, and we need also to calculate the high of that level. Yeah, and on Friday, I think I took an advantage of this previous low. After price breaks that channel, it comes back to give us that low. There, we did that, and we got that move. So yeah. Price has swept liquidity above that high, and price came back to correct. So somehow, if you wanted to catch that area there, it was possible to just use the Fibonacci and 61.8% price. That's why price started turning. We were expecting a correction, and two, sometimes because of too much information, you end up forgetting stuff. But that was an SMS created. That was an alarm that price is going to change direction, because the previous high was not challenged. SMS. So this price failed to break the high, but challenged the low. I think challenged the lows. Guys, there's a distinction between being biased in a particular direction and what actually price action is telling you. It's two different things. So just try and master what price action is actually saying, what the price is actually doing. Because here, if you have the mind of wanting price to buy, and you've just got the concept of God is going to buy, you literally miss out on this and you don't know what's happening. So if you can see the structure here that I'm going to take you through, guys, you will see that if you had followed this type of understanding, it was easier understanding the correction and the impulses presented. So we have that area low called the break of change of character, we can call in this perspective. Change of character, price breaks the change of character, wait for the first high of this move. That becomes your demand supply zone. Yeah, that becomes your supply zone. And it's your liquidity level. The type of liquidity here that you find is called the buy side liquidity. Buy side liquidity. Buy side liquidity. Yes, sir. Buy side liquidity. Now, this is just because of fundamentals, guys. This was yesterday's Federal Market Open Committee reaction. But normally, what happens is you wait for this move to spike above that level. So we basically could have caught the news. Wait for price to spike above that level, and when it closes below, but this was massively fast. It was actually playing in dancing and dancing. So in a normal market development, you could have caught that sell because it just starts to drop without noise. Break of market structure, guys. Okay, I don't, just to avoid noise, there's also a break of market structure there. Break of market structure. And then we have a new potential break of market structure. So price touched that level and dropped, right? So that is also another break of market structure there. BMS. Break of market structure. And we have another break of market structure here. So now they say that the rule is that try and trade in the direction of the break of market structure. Try and trade in the break of market structure. Basically, that's where market is going. And when we go towards the trend line, then price over should expect a swing in price. But and also I'm thinking price, if price gives you that double tap on the thing, it gives you a nice shoot to the upside. Also, because we are testing this big supply zone becoming demand. So let's see what happens here. We have that is our liquidity, most likely liquidity level, and if that's the case, then the last okay, I think that won't work. I wanted to suggest something, but yeah, we'll see the last bearish candle before the push to the upside will become an order block. Yeah, so usually price will drop after sweeping liquidity. We don't enter the market. Let me say that point. After the sweep of liquidity, price comes from here, sweeps liquidity. We don't enter that market because the bank's action. We will have to wait for price to correct below and sell. Okay, but we have in the mind, we have the idea that price is gonna obviously resist because of this previous behavior. And we are in a correction ABC. So the correction ABC is not much to the downside unless we're in a bullish market. Yeah, so and this is what we have. Price has given us a new high. A new high lay. Price has given us a new high. Potential change of character. Potential change of character. So it would be nice. It would be nice actually to see price breaking above that level. It would be nice to see price breaking above. This is 1 hour time frame. And yeah, guys, so this is my anticipation. If that doesn't work, guys, below that same area, we can have price doing that. And then we'll see. Once it does that, then we'll start studying good. We'll take that as a break of structure and then waiting for that highs to sell now. So thank you so much, guys. That's Victor, and wishing you guys best trading day. Cheers.